Let me tell you something your real estate agent will never mention. During that sunny open house tour, State Farm, the largest home insurer in America, stopped writing new policies in California. Allstate followed. Farmers pulled back. In Florida, over a dozen insurers have gone completely bankrupt since 2022. This isn't a temporary market correction. This is an insurance exodus. And here's why it should terrify you. See, in America, there is an invisible link between your home's value and a piece of paper from an insurance company. If you can't get insurance, you can't get a mortgage. If you can't get a mortgage, the only people who can buy your house are cash buyers, investors looking to lowball you by 40%. Your $500,000 retirement nest egg. It just became an uninsurable asset worth whatever some hedge fund feels like offering. Real estate agents won't tell you this, but the actuaries at State Farm will. They've done the math. They've run the climate models. And they're leaving. You aren't just buying a house anymore. You're buying a subscription to a disaster. Today, we're counting down 10 towns where insurance companies have either fled, dramatically scaled back, or are charging premiums so high they exceed your mortgage payment. These are places where the American dream has become financial suicide. From tornado-ravaged Oklahoma to the hurricane-battered Gulf Coast, these are the towns the insurance industry has quietly abandoned. And if you own property in any of them, you might already be trapped. Let's break it down. Number 9. Norfolk, Virginia. Norfolk doesn't make national headlines like Miami or New Orleans. But in the insurance industry, it's a code red market. Private flood insurers have been quietly pulling back from the Norfolk metropolitan area for years. Companies like Assurant and Hiscox have tightened underwriting. The National Flood Insurance Program, NFIP, is now the primary option for many homeowners, and as you'll see, that's not a safety net. It's a warning sign. When the private market abandons an area and you're forced onto a federal program, you're not getting a better deal. You're getting the state of last resort. Norfolk has a problem that money can't fix: geography. The city sits at sea level on the Chesapeake Bay, built on land that is literally sinking. It's called subsidence. The ground itself is dropping by about 1 to 3 millimeters per year. Meanwhile, sea levels in the region are rising faster than the global average due to changes in the Gulf Stream. Combine sinking land with rising water, and you get relative sea level rise. That's among the worst on the East Coast. Tidal flooding, called sunny day flooding, now occurs over 10 days per year in Norfolk. Not during hurricanes, just regular high tides. Roads flood, parking lots flood, basements flood, and every flood is a claim. Insurers don't price based on today's reality. They price based on tomorrow's probability. And tomorrow, Norfolk is underwater literally. In 2021, the FEMA restructured the NFIP under a program called Risk Rating to .0. The goal was to make flood insurance pricing reflect actual risk. For Norfolk homeowners, this meant one thing: massive premium increases. Homeowners who were paying $800 a year for flood coverage are now seeing quotes of $3,000 to $5,000. Some properties in the most flood-prone zones have been quoted $8,000 or more annually just for flood coverage. That's on top of regular homeowners insurance, which runs another $2,000, $3,000 in the area. We're talking about $10,000 plus per year in combined insurance costs for a home. That might be worth $350,000. At that point, premiums are higher than your mortgage interest. Norfolk has a massive military presence. It's home to the world's largest naval base. That creates a captive population of families who have to live in the area. They can't just move to escape flood risk. They're stationed there. For civilian retirees, the trap is even worse. You bought a waterfront home in 2010 thinking you'd retire watching boats sail by. Now, your flood insurance costs more than your property taxes. Your homeowner's premium has doubled. And when you try to sell, buyers are doing what smart buyers do. They're calculating total cost of ownership. And that calculation says your home isn't worth what Zillow claims. You're underwater financially, and soon you might be underwater literally. In Norfolk, the ocean isn't coming someday. It's already here 10 days a year and counting. The insurance industry noticed. The question is, did you? Number 8. Myrtle Beach, South Carolina. Florida is ground zero for the insurance apocalypse. Myrtle Beach is the next domino, and it's already wobbling in 2023 and 2024. Multiple regional insurers in South Carolina announced they were either leaving the coastal market entirely or dramatically reducing their exposure. Companies like Lighthouse Property Insurance and others have pulled back. The state's insurer of last resort, the South Carolina Wind and Hail Underwriting Association, is seeing application volume spike when the last resort becomes the first choice. The market is broken. Myrtle Beach markets itself as the Grand Strand, 60 miles of beautiful Atlantic coastline, but insurers see something else: 60 miles of hurricane exposure. The area was hammered by Hurricane Florence in 2018, which dumped historic rainfall and caused catastrophic flooding. Hurricane Ian in 2022 brought storm surge and wind damage as it tracked up the coast, and the 2024 hurricane season reminded everyone that South Carolina is, nay, sometimes targeted as becoming a frequently target. But here's what makes Myrtle Beach particularly vulnerable: it's not just hurricanes. The region has aging infrastructure, extensive development in flood zones, and a tourism economy that has pushed construction into every available inch of beachfront property. When a storm hits, the damage is dense and expensive. The average homeowner's insurance premium in Myrtle Beach has increased by over 40% since 2020. Homeowners who were paying $2,500 are now paying for $1,000. Those closer to the beach, $6,000 to $9,000 isn't unusual. And that's before flood insurance, which is effectively mandatory within FEMA flood zones. Add another $2,000 to $4,000 for that. Do the math. That's nearly 5.5% of the home's value every single year just to insure it, not to pay it off, just to protect it. Myrtle Beach has long been a retirement destination for middle-class Americans from the Midwest and Northeast. Affordable condos, warm weather, golf courses everywhere. It seemed perfect. Now, those retirees are getting letters from their HOA explaining that the building's master policy has tripled. Special assessments are coming. Monthly fees are going up $300 for $100, $500 to cover the gap. Some can't afford it. They try to sell, but who's buying a condo with $800 month HOA fees in a building? That's struggling to find insurance. They're not selling, they're surrendering equity. Myrtle Beach spent decades pretending it wasn't Florida. Insurance companies have finally noticed. It is. Welcome to the next Florida. Same storms, same problems, no warning. Number 7. San Bernardino County, California. In 2023, State Farm announced it would stop accepting new applications for homeowners insurance in California. All of California, the largest insurer in America, simply said, "We're out." Allstate had already stopped writing new policies. Farmers scaled back. For homeowners in San Bernardino County, one of the largest and most fire-prone counties in the state, this wasn't an inconvenience. It was a death sentence for home values when major carriers refuse to write new business. They're not being cautious. They're telling you something. This place is uninsurable. San Bernardino County is massive, over 20,000 square miles, the largest county in the continental United States. Much of that land sits in what California calls the wildland-urban interface, or WUI, areas where developed neighborhoods meet undeveloped brush and forest, and that brush burns. The region has seen devastating wildfires repeatedly: the Blue Cut Fire, the Old Fire, countless smaller blazes that make local news but don't penetrate national consciousness. Each fire teaches insurers the same lesson: homes near the brush are not homes, they're kindling, waiting for ignition. Climate change has extended fire seasons. What used to be a few dangerous months is now a year-round threat. Insurers model this. They see 20 to 30% of San Bernardino homes sitting in high or very high fire severity zones, and they've decided the math doesn't work. Homeowners who could get private insurance a few years ago for $1,500, $2,000 annually are now facing quotes of $5,000 to $10,000 if they can get quotes at all. For many, the only option left is the California FAIR Plan, the state's insurer of last resort. But the FAIR Plan isn't cheap. It provides limited coverage, typically just fire, and still charges $3,000 to $6,000 or more, depending on the property. Homeowners then have to buy a separate difference in conditions policy to cover everything else: theft, liability, water damage. Total annual cost $8,000 to $15,000 isn't rare for a modest home in a high-risk area. One homeowner in Running Springs reported paying $11,000 a year in combined coverage for a home worth $350,000. That's financial suicide disguised as home ownership. Young families bought homes in San Bernardino County because they couldn't afford Los Angeles or Orange County. It was the affordable alternative. The trade-off was a longer commute, but you got more space, more house, and could actually build equity, except now that equity is evaporating. When buyers can't get insurance or can only get coverage that costs $10,000 a year, they may not offering asking price. They're offering 70 cents on the dollar if they're offering it all. Sellers are stuck. They can't afford to stay with ballooning premiums. They can't afford to sell at the prices buyers are willing to pay, and refinancing, good luck. Lenders won't touch a property without proof of coverage these families saved for years to buy their first home. Now they're trapped in an uninsurable asset. In San Bernardino, you don't need to see flames to lose your home. You just need to see your insurance cancellation notice. The fire zone isn't just a map designation, it's a financial prison. Number 6. Galveston, Texas. Galveston Island sits in the Gulf of Mexico like a beautiful target. Insurers have noticed. Major carriers have been scaling back coverage on barrier islands across Texas for years. But Galveston is the poster child. Many major insurers simply won't write new policies on the island. Those that do charge rates so high that the insurance cost exceeds the mortgage interest. When your main insurer is the government because private companies won't touch you. That's not protection. That's a red flag wrapped in bureaucracy. Galveston has been destroyed before. In 1900, a hurricane killed an estimated 8,000 to 12,000 people, still the deadliest natural disaster in American history. The city rebuilt, raised the grade level, constructed a seawall. But it's still a barrier island. Barrier islands exist to absorb storm energy. That's their geological purpose. Galveston takes direct hits from Gulf hurricanes with terrifying regularity. Ike in 2008 caused over $30 billion in damage and devastated the island. Harvey in 2017 brought record flooding. Every few years, Galveston braces for another blow. Insurers aren't pricing for if a major storm hits. They're pricing for when. Windstorm insurance through TWIA for a modest Galveston home can easily run $5,000 to $8.00 per year. Just for wind coverage, add standard homeowners insurance, which excludes wind in coastal Texas at another $2,000, $3,000. Add flood insurance at $2,000 for $1,000. Total annual insurance bill, $10,000 to $15,000 for a home worth $400,000. One retired couple I researched bought their Galveston home in 2015 for $320,000. Their combined insurance costs have risen from $4,500 to over $11,000 annually. Their mortgage payment is $1,400 a month. Their insurance payment is now $916 a month. Let that sink in. Premiums higher than mortgage interest isn't a hypothetical here. It's the reality. Galveston attracts retirees, vacation home buyers, and people who dream of island life. The houses have views. The lifestyle seems idyllic. But when these buyers go to sell, they're facing a market where insurance costs are the first question buyers ask, not the last. Some buyers are walking away entirely when they see the insurance quotes. Others are demanding price reductions of $50,000 or more to offset the ongoing costs. Sellers who bought at the peak, hoping to enjoy a few years and then cash out, are discovering there's no clean exit. The island is beautiful, but it's become a barrier island trap, easy to get into, expensive to escape. In Galveston, you're not buying a house. You rate leasing a front row seat to the next hurricane and paying more for that seat than some people pay for their entire home. The ocean view comes with a price and the insurance bill proves it. Number 5. New Orleans, Louisiana. After Hurricane Ida in 2021, something broke in the Louisiana insurance market that has never been fixed. 12. That's how many insurance companies have gone insolvent in Louisiana since Ida. Not pulled back, not raised rates, gone bankrupt, liquidated. Companies like Lighthouse, Southern Fidelity, and FedNet simply ceased to exist, leaving hundreds of thousands of policyholders scrambling. The Louisiana Department of Insurance had to step in to manage the chaos, but there's no managing a broken market, only surviving it. New Orleans needs no introduction to disaster. Katrina in 2005, Isaac in 2012, Ida in 2021. The city sits below sea level, protected by a levee system that failed catastrophically once and requires constant maintenance and upgrades. But Ida was different. It wasn't just flooding, it was wind damage across a massive area, extending from the coast all the way through Baton Rouge. Insurance claims overwhelmed smaller regional carriers, companies that had been skating by on thin. Reserves suddenly faced payouts they couldn't afford. They folded. Insurers that survived looked at the data and asked a simple question: why are we here? Louisiana Citizens, the state's insurer of last resort, is no longer the insurer of last resort. It's becoming the insurer of only resort. Citizens was designed to be expensive, to incentivize people to find private coverage. Mission accomplished. Citizens policies routinely cost $4,000 to $8,000 annually, double or triple what private coverage used to cost. But when there's no private coverage available, the expensive option becomes the only option. And flood insurance, which is separate, adds another $2,000 to $5,000 on top. New Orleans has a culture that people don't want to leave. Generations of families have lived there. The music, the food, the community, it's not something you abandon lightly. But the insurance market doesn't care about culture. Retirees on fixed incomes are watching. Insurance consume an ever-growing share of their budgets. Some are pulling from retirement savings to cover premiums. Others are taking out loans to pay for mandatory coverage their lenders require. And selling, you can try. But buyers are doing the math, and the math says even if the house is priced fairly, the total cost of ownership is astronomical. These homeowners are stuck emotionally attached to a city that's become financially hostile to live in. In New Orleans, the insurers didn't just leave. They died, and when they died, they took the market with them. You're not buying into a city with insurance challenges. You're buying into a market that fundamentally no longer works. The state is holding it together with duct tape and prayer. Number 4. Paradise, Chico, California. In November 2018, the Camp Fire swept through Paradise, California, killing 85 people and destroying nearly 19,000 structures. It remains the deadliest and most destructive wildfire in California history, and when it was over, insurance companies didn't rebuild their presence. They vanished today. Getting traditional homeowners insurance in Paradise or the surrounding Chico area is nearly impossible. Major carriers won't write policies. Regional carriers have either left or charged rates that would make a Wall Street banker wince. The town is rebuilding slowly, but it's rebuilding into an uninsurable future. Paradise sits in the Sierra Nevada foothills, surrounded by the same vegetation that burned in 2018, the conditions that created the camp. Fire, dry fuel, strong winds, aging infrastructure, and climate-driven drought haven't changed. Insurers know this. They also know something else. Once a catastrophic wildfire destroys a community, the rebuilding happens in the same location, new homes go up in the same high-risk zones. It's not if another fire will come, it's when. For an insurance company, Paradise represents an asymmetric bet. Collect premiums for a few years, then face massive losses when the inevitable happens. The smart ones refuse to play. For the few homeowners who can get private insurance in Paradise, annual premiums of $8,000 to $15,000 are standard. Many can't get private coverage at any price and are forced onto the California Fair Plan. But the Fair Plan only covers fire. Homeowners need separate policies for liability, theft, and other perils, adding thousands more per year. Some families rebuilding in Paradise are reporting total annual insurance cost of $12,000 to $20,000 for homes worth $300,000 to $400,000. That's for the 6% of home value annually just to insure it. More troubling, many homes in Paradise are now being sold cash only. When a buyer can't get insurance, they can't get a mortgage. So, homes sell to investors or cash buyers who self-insure or simply don't. This has created a parallel market where prices are depressed because the buyer pool is limited. Your home is worth what an insured buyer can pay. If no insured buyers exist, your home is worth less. Some residents of Paradise refused to leave. They rebuilt. They fought through bureaucracy, supply chain delays, and trauma to reconstruct their lives in the town they loved. Now they're discovering that their rebuilt home, their testament to resilience, is an asset they can never sell at fair value. One couple who rebuilt in Paradise after losing everything in 2018 has tried to sell 3 times. Each time, buyers have backed out after seeing insurance quotes or being denied coverage entirely. The couple is now in their late 60s, tied to a home they can't sell, paying insurance premiums that drain their retirement savings. They didn't just survive a wildfire. They survived into a trap. Paradise burned, and then it became a cash-only market if you can't get insurance. You can't get a mortgage if you can't get a mortgage. Your home's value is whatever a cash buyer says it is. This isn't recovery, it's financial quarantine. Number 3. Lake Charles, Louisiana in 2020. Hurricane Laura made landfall near Lake Charles as a Category 4 storm. 6 weeks later, Hurricane Delta hit nearly the same spot the following year. Ice storms crippled the region, then came flooding. Lake Charles has experienced what emergency managers call compounding disasters, multiple catastrophic events in rapid succession before recovery from the previous one is complete. Insurers responded the only way they know how. They left today. Major carriers simply refused to write policies in Lake Charles, not limited availability, not higher deductibles, outright refusal. The town has been abandoned by the insurance industry. Lake Charles sits on the Louisiana-Texas border, directly in the Gulf Hurricane Alley. But what makes it uniquely vulnerable is its industrial concentration refineries and chemical plants. That makes storm damage both dangerous and expensive. When Laura hit, winds of 150 miles per hour tore through the city, shredding roofs, collapsing structures, and causing billions in damage. Delta, just weeks later, reopened wounds before they could heal. Insurers assess a simple question: what's the probability of major loss in Lake Charles? That probability isn't a calculation, it's a certainty. The only unknown is timing. For Lake Charles residents who can get coverage, premiums have tripled or quadrupled since 2019. Homeowners who paid $1,800 are now paying $6,000 or more. Many are being quoted $8,000 to $12,000 annually. A significant number of homeowners have simply given up on insurance. They're going bare, living in their homes without coverage, gambling that another disaster won't happen, or that they can somehow absorb the loss if it does. This creates a cascade effect. When the next storm hits, uninsured losses mean FEMA pays out more, taxpayers subsidize the disaster, and the cycle continues. Others are relying on Louisiana citizens, which is swamped with applications and charging rates that are only slightly less brutal than going without 5% of home value every year just to maintain the privilege of ownership. Lake Charles was never a wealthy city. It's working class, with refineries and chemical plants providing middle-income jobs. People bought homes they could afford, paid their mortgages, and expected to build generational wealth. Now those families are watching that wealth evaporate. Homes that should be worth $100, zero, are selling for $120,000 or less because buyers factor in the insurance cost and adjust accordingly. Retirees who plan to sell and relocate are stranded. Younger families who wanted to stay near parents are reconsidering. The population of Calcasieu Parish, where Lake Charles sits, has declined since 2020. People are leaving not because they want to, but because they can't afford to stay. This is what economic displacement looks like. Not a single dramatic event, but the slow bleed of insurance-driven exodus. Lake Charles got hit by the hurricanes in 6 weeks, and then hit by ice storms the following year. And you know, what's more devastating than all that weather? The annual insurance bill. This town wasn't just damaged, it was forgotten. And insurers have forgotten it exists entirely. Number 2. Miami, Florida. Miami's insurance crisis isn't just about hurricanes. It's about something more insidious. The condo market is collapsing under the weight of insurance costs, litigation, and regulatory chaos. Since 2020, over a dozen insurers have fled the Florida market entirely. Those that remain are raising rates by 40%, 60%, or more annually. But for condo owners, the crisis is even worse. Building master policies, the insurance that covers the structure itself, have increased by 100%, 300%, even for 100%. And those costs get passed directly to owners through their HOA fees. Miami faces every insurance nightmare simultaneously. First, there's hurricane risk. Miami is in the crosshairs of Atlantic storms, and climate change is making those storms stronger and wetter. Second, there's flood risk. Much of Miami sits on porous limestone at or below sea level. Rising seas, king tides, and increasingly intense rainfall all contribute to flooding that's becoming impossible to manage. Third, there's litigation. Florida has earned the dubious distinction of being the most litigated insurance market in America. Assignment of benefits, OB abuse, inflated claims, and attorney-driven lawsuits have driven carriers out. Florida accounts for about 8% of U.S. homeowners insurance claims, but over 70% of insurance lawsuits. Insurers aren't just paying for storms, they're paying for lawyers. But the fourth risk is specific to condos: structural integrity. After the Surfside building collapse in 2021, which killed 98 people, Florida passed new laws requiring inspections and reserves for older buildings. Insurance companies, suddenly aware that many older condos have deferred maintenance and structural issues, jacked up premiums, or canceled policies altogether. Condo HOA fees in Miami have become unrecognizable. A unit that had for $100 month HOA fees in 2020 might now be paying $800 or $1.00, with the increase almost entirely driven by insurance. Buildings that paid $500 annually for master policies are now paying $2 million or more. One South Beach Condo Association reported their master policy went from $600,000 to $2.4 million in a single year for 100% increase. That cost was divided among owners as a special assessment of $35,000 per unit, plus permanently higher monthly fees. Retirees on fixed incomes who budgeted $500 a month for HOA fees are now facing $200 per month or more in special assessments that require tens of thousands of dollars they don't have. The Miami condo market was the retirement dream for countless Americans. Affordable units, warm weather, access to culture and beaches. Snowbirds and permanent retirees alike poured into high-rises, expecting to age in place with ocean views. Now they're being forced out. Some owners can't afford the new HOA fees. They try to sell, but who's buying a condo with $1,000 month fees and a recent $40,000 special assessment? Buyers are walking away. Units that would have sold for $350,000 in 2019 are now struggling to move at $220,000. Others are facing a darker scenario. HOA letters are forcing sales of units from owners who can't pay assessments. Seniors who paid off their condos decades ago are being told, come up with $35,000 or lose your home. This isn't the American dream. It's a financial nightmare inflicted on people who played by all the rules. In Miami, your $401k isn't competing with inflation, it's competing with your HOAS insurance renewal. Retirees who thought they owned their condo are discovering they merely rent it from their insurer. Welcome to the condo crisis, where 100% premium hikes are normal and selling at a loss is the best case scenario. Number 1. Cape Coral, Florida. If there is a single place in America that represents the complete collapse of the insurance market, it's Cape Coral, Florida. After Hurricane Ian in 2022, the facade crumbled completely. Insurers that had been limping along went insolvent. Major carriers that had stayed in Florida announced they were done. Homeowners who had coverage suddenly had nothing, their carrier bankrupt, their claims unpaid, their homes uninsurable. Cape Coral is ground zero for the insurance apocalypse. It's the canary in the coal mine. Except the canary has already died and the miners are still going in. Cape Coral sits on the Gulf Coast of Florida, built on a network of canals that were dredged in the 1970s. Those canals were designed for boating access, not flood protection. When Ian's storm surge came, the canals became highways for water, flooding neighborhoods that had never flooded before. But the flooding wasn't the only issue. Wind damage was catastrophic. Ian's wind stripped roofs, shattered windows, and destroyed structures across the city. Claims poured in by the thousands and several insurers simply couldn't pay. Climate models show Cape Coral's risk is only increasing. Warmer Gulf waters fuel stronger hurricanes. Rising sea levels amplify storm surge. The city sits 6 feet above sea level on average, not nearly enough margin for error. Insurers have done the math. The expected losses in Cape Coral now exceed what any premium structure can sustainably cover. The only rational premium would be so high that no one could afford it. So instead of charging that premium, insurers left before Hurricane Ian. A typical Cape Coral homeowner might pay $2,500 to $4,000 annually for home insurance. Today, $10,000 to $15,000 is the norm for those who can get coverage at all. And many can't. Homeowners are being non-renewed by carriers who are allowed to do so by simply claiming the risk is unacceptable. New buyers are being denied coverage outright, no quote, just rejection. One family I researched purchased their Cape Coral home in 2019 for $385,000 with insurance costing $3,100 annually. After Ian, their insurer went bankrupt. Their new quote from Citizens, Florida's state insurer, was $14,500 per year. The policy had higher deductibles and less coverage. Their monthly insurance payment is now higher than their monthly mortgage payment. For middle-class families, this isn't a strain, it's financial suicide. Cape Coral was marketed as the Florida dream for working-class and middle-class buyers. Affordable homes with canal access, golf courses, sunshine. It attracted retirees, young families, and investors alike. Now those buyers are discovering the brutal truth. They can afford their mortgage, but they can't afford to keep their house. Sellers are stuck in a nightmare when a buyer tries to purchase a home in Cape Coral. Their lender requires proof of insurance. If the buyer can't get coverage or can only get coverage at $15.00 per year, they walk away. Deals fall through constantly. Homes that were worth $500,000 in 2021 are now listing for $350,000 and still not selling. The few sales that do happen are often cash buyers, investors who self-insure, or simply gamble without coverage. Retirees who expected to sell their Cape Coral home to fund their next phase of life are watching that plan evaporate. They can't sell for what they paid. They can't afford to stay. With premiums eating their retirement, they're trapped. And unlike earlier entries on this list, there's no clever workaround. No relocating to a cheaper part of town. No finding an alternative carrier. The entire market is broken. Cape Coral isn't just uninsurable, it's functionally unsellable for anyone who needs a mortgage to buy. If you own property here, you don't own an asset, you own a subscription to a disaster that costs $15,000 a year and comes with no guarantee of renewal. This is what happens when paradise becomes a financial prison, the American dream, drowned in storm surge and buried under premium notices. So, there you have it, 10 towns where the insurance industry is done. What real estate agents never will tell you the truth about where not to buy. These aren't warnings from alarmists. They're signals from actuaries, State Farm, Allstate, farmers companies that have spent decades calculating risk-car voting with their feet when they leave a market. It's not a temporary setback, it's a verdict. Here's my final advice. Before you buy any property, especially in a coastal or disaster-prone area, request a clue report. That's the comprehensive loss underwriting exchange, a database that shows claims history on a property and can signal whether an area is becoming uninsurable. Ask for insurance quotes before you make an offer, not after. And if you can't get coverage, or if coverage costs more than 3% of your home's value annually, walk away or look inland. There are plenty of beautiful, affordable places in America where insurers are still happy to write policies. The American dream isn't dead, but if you buy in the wrong place, your financial future might be. Don't say I didn't warn you. If you found this video valuable, subscribe and hit the notification bell. I'll see you in the next one.